Hey everyone, welcome to another stream here. I am Joe Porreca, and as always, it's Wednesday. So we're going to talk a little bit about real estate and the latest developments in the real estate market. I hope you're ready for another great stream. Thanks so much for joining me. I'm glad you're here. And if you're watching on the replay, I'm glad you're watching the replay. Before we get into it, if you guys like the content, if you like the stream, do me a huge favor. Just hit that like button down below. Hit subscribe if you really like the content. It helps me out. So today we are talking about the re-emergence of 0% down loans. I know, it's freaking wild. I can't believe it's happening, but we're going to get into that very, very shortly. Before we do, I just want to preface this with, hey, this is a real estate live stream. I am a real estate agent. However, I try to be as impartial as possible and just present the information based on what's there. So you'll probably find that I'm not the typical real estate agent that's just pushing people to buy homes because. So with that being said, I think this is a really important topic because the topic of home affordability is extremely popular right now. Interest rates are really high. We all know it's really freaking tough to afford buying a home. So that's why I want to talk about this topic, because this is something that, people will see and go, oh, this might lower my barrier to entry for potentially owning a home, which can be true, but as with most things in life, it's a double-edged sword. So we're gonna get into it really quick. For those of you watching live right now, drop a comment below. I would love to know where you're watching from, what market you're in and what that market is doing, because as we all know on YouTube, this is live all over the globe. You could be watching from anywhere. So I love to know who's watching and from where. It gives me a little bit of context. And real estate is a hyper local subject. So again, the things I'm talking about might not apply to your area. They might apply to your area. But it's good general knowledge. So let's get right into it. I've got an article I'm going to throw up on the screen. I've actually got a couple articles and a video that we're going to take a look at tonight. At any time, if you guys have questions about anything, whether it's related to this topic or maybe even not related to this topic, pop it into the comments, ask your question. I'd love to hear from you, and I'd love to know what you think. Do you guys think 0% down mortgage options are a good thing? Do you think that there's something that we should utilize as consumers? Or maybe do you think that maybe it's a bad idea and maybe something we shouldn't utilize? Let me know in the comments below, and let's get straight into it. So here we are. So this article comes from Yahoo Finance. I like Yahoo Finance because they're pretty good about just kind of delivering the information. I can't sense a whole lot of bias. Of course, in financial articles, it's a little bit difficult to kind of convey that biasness, but I have a couple other articles as well. But we're going to start with this one. This one's a little bit shorter and a little bit more concise. This is kind of an overview of the 0% down idea here for mortgages. So we're going to get right into it. So zero down payment mortgages return amid high housing costs. And again, this is of June 4th. So just yesterday morning, this article came out. And kind of interesting. So United Wholesale Mortgage, UWM, with billionaire Matt Ishiba at the helm, which is, by the way, the owner of the Phoenix Suns basketball team. Fun fact, there will be a quiz later, so take notes, has launched a new 0% down mortgage program. This program allows qualified buyers to finance 97% of their home's value with the first mortgage. Now, that's nothing new, right? So actually right now with an FHA loan, you can put down as little as 3.5%, which would be a 96.5% loan. So that's really nothing new, but here is where it gets to be a little bit newer. I'm going to make this even a little bit bigger because I think I've got plenty of room. There we go. Now you guys can see. The remaining 3%, so 97% of the home purchase would be financed, and the remaining 3% usually would be where you have to come up with that minimum down payment. However, the remaining 3%, up to $15,000, which that's a really, really important note, is covered by a secondary mortgage that carries no interest but must be repaid in full when the home is sold. the mortgage is paid off or the owner refinances. So you might think to yourself, hey, that sounds like a pretty good deal, a no interest loan, which is true. That is good. But there's a couple catches here, and there'll be more as we go on. The most important thing here is that if that owner decides to refinance, that second mortgage of 3% up to 15K, that doesn't mean it's going to be 15,000, because again, that it's a percentage, so it's based on the sale price of the home. But up to that $15,000 has to be paid off. So if interest rates go down in the next 2 years or a year and a half or the next year, which would be nice, but who knows what's actually going to happen? We just that's one of those things that we could speculate. But people have been trying to figure out what the Fed is going to do with interest rates for the last 2 years, and nobody's gotten it right. So, but let's just say if you do refinance in the next year, you have to have $15,000 cash to pay that off. And if you're someone that's utilizing a basically 100% finance loan product, you probably don't have a whole lot of spare cash laying around. So that could be one obstacle that consumers need to pay attention to. And if you excuse me, I'm going to crack this LaCroix bubbly water. So if you hear the sound of a can opening, all this talking makes me a little bit thirsty. Okay, let's continue. For example, purchasing a home appraised at $300,000 would entail a $9,000 no interest loan for the down payment. To qualify for the maximum $15,000, the house must be valued at $500,000. So this is interesting because you think to yourself, oh man, a lot of people, I can tell you right now, which is why I titled the stream this way, oh, it's going to be a flashback to 2008. And I'm going to get into that a little bit later and more in depth, the difference between 0% down in 2008 versus 0% down today with this program. But, a lot of people think, oh, 0% down, like this is going to run rampant. People are going to over leverage this. People are going to take advantage of this type of product. And we're going to be headed for hot water, which we may or may not. Again, we'll talk about that more a little bit later on. But it's important to realize that this is only for properties up to $500,000. So in many, many areas, in many, many states, that's not even the average price of a home. So here in California, where I am, again, I'm in Claremont, California, which is about 35 miles east of downtown Los Angeles. So we are technically considered a suburb of LA. We are in Los Angeles County. We are Los Angeles, but we're not really Los Angeles. We're really on the cusp. We're on the outskirts. But here in LA County, the median priced home is now $900,000. And in California, the median priced home is closer to $750,000. So this program wouldn't even be a viable option for the average home in California. Now, that's not to say that there aren't homes out there that would fall under the $500,000 price point. There are neighborhoods, there are homes that would qualify, and people could utilize this. But it's important to note that this isn't like, oh, we'll do 100% financing up to $1 million. Then in that case, that could be abused and over leveraged. So that's a really small detail, but it's also a really important detail to keep in mind as we learn about this and discuss it. The down payment assistance is calculated based on the lower appraised value or the sales price, which is significant in competitive markets where buyers often pay more than the appraised value. So I'll read that one more time because it's kind of important. The down payment assistance is calculated based on the lower appraised value or the sale price, which is significant in competitive markets where buyers often pay more than the appraised value. I don't think that's written super clearly, but what they're basically trying to say is whatever the lower value is, whether it's the sale price or the appraised value, sometimes buyers have to bid over depending on the market. We're all aware of this where, there's one home for sale and there's 3 or 4 offers. And most of the time in that situation, the home sells for over the asking price. And sometimes there is a situation that arises where the appraiser comes out and says, hey, I know Mr. Mrs. Buyer, you said you'd pay $400,000 for this house, but it's really only worth $385,000. Well, according to this program basically will work for that lower appraised value. So who qualifies for a zero mortgage? Dominic has a question. Let's put this up on the board. Dominic, thanks for stopping by. Hope you're having a good evening. Can you name a market where appraisals are coming in above the sale price? I can't. So where appraisals are coming in above the sale price, I will say that most of the times when it comes to appraisals for a purchase, and this is where people get a little bit confused. When there is an appraiser that is dispatched and assigned to appraise a property as part of a purchase agreement, so that's most of the appraisals out there. That appraiser is only looking to see if that property meets that value. So that appraiser is not really looking to see what the true value is. I know this is kind of confusing. Let me know if this doesn't make sense. I'm happy to expand. But essentially, that appraiser is not looking for the maximum value or even perhaps the market value of the property. That appraiser is just looking, based on comps and neighborhood sales, if that price that has been agreed upon by the buyer and seller works for the bank. Do they believe that the home has the value there? So while we oftentimes think that like the appraisers are the end all be all of what is this home worth, and if they say, oh, it's actually worth, $20K less than you promised to pay for it, that's not always the case, because most of the time the appraisers are just looking to see if it fulfills and satisfies the value, fulfills and satisfies the contract. Now, to answer your question a little bit more directly, can you name a market where appraisals are coming in above the sale price? It's not common that occurs, but it has happened. I've had it happen actually on a couple of my deals. One most notably was back in the post-pandemic era. This was in 2021. My very good friend, my good buddy from college, wanted to buy a house with his wife, and I helped him with that. And they purchased a single-family detached home in Homeownership Valley, which is an area kind of it's not quite Riverside. It's right before Riverside, but it's like San Bernardino County. And they purchased the home. I believe their contract price was around $630,000. And the appraiser actually said the home was worth $655,000. So the moment they owned the home, they technically had $20K worth of equity. And most recently, I sold a home here in Claremont. This was only like a month ago. The buyers bid $1,130,000, so just over $1.1 million on a home, and the bank said it was worth 1.150 as an appraised value. So again, they're walking in with some equity, but at the end of the day, value is what someone is willing to pay for the commodity. And while we can, kind of put all this together with comps and metrics and things like that, it's just one method to arrive at valuation. So hopefully that answers your question. All right, let's continue on. So who qualifies for a zero down mortgage? This is really important. The program is open to first-time homebuyers and middle-income consumers earning up to 80% of the area's median income. Buyers need a FICO credit score of 700 or higher, while those qualifying based on the 80% income threshold need a score of at least 620. So ideally targeting first-time home buyers or buyers that are earning up to 80%. So that would be a little bit less than the area's median income. And some ads. Okay. So UMW, which is the one of the nation's largest mortgage companies, they're the ones that are putting this, that offer this product. So UMW's 0% down purchase program is going to change the game this purchase season. Ashiba, president and CEO of UWM, said in a news release, no other wholesale lender in the country offers this, meaning independent mortgage brokers now have a significant advantage with consumers and real estate agents. Thousands of borrowers are sitting on the sidelines because they don't have a down payment. This program removes that barrier, which this is a little bit of this remark is a little bit of sort of a rose-tinted glasses approach, thinking that, hey, this is really going to open things up. And he's not wrong. A lot of people are sidelined on the home market because they can't afford down payments, because especially depending on what market you're in, if you're trying to save up even 10% for a down payment now to, a median house, the median house price in the US is about $450,000. So that's $45,000 for trying to do 10% down. That's not a small amount of money. That's a good amount of money. However, what you have to consider is if you put 0% down, you're going to have a very, very high monthly payment. And that's one of the things that we'll talk about when we kind of talk about some of the pros and cons of this. So obviously one pro is that it's going to get people off the sideline a little bit, or potentially could get people off the sideline a little bit. But one of the cons is, again, it's a double-edged sword. Their monthly payment is going to be very, very high. Hey, John, we have a question here. Even though we may not need to finance, is it still a good idea to get pre-approved prior to selling our Claremont home? This is a great question, John. And this could apply to anybody selling a home anywhere, not necessarily just in my area of Claremont, not just in California, but all over the nation and the world. So let's say, in the position that John might be in where, I have a house to sell. I've got a lot of equity. Again, let's recap what equity is. Equity is the word given when your house has a certain value and you owe anything less than that value. The difference is your equity. So if you have a home worth $500,000, the loan that you have on it, there's still a balance of $300,000. The equity is the difference, which is $200,000. So let's say you've got good equity, you're going to sell that home, and maybe you can buy the next home cash, which is great. That's a wonderful thing. That's a great spot to be in. However, to the question here, is it a good idea to get pre-approved prior to selling our Claremont home? I would say yes. And here's why. Because getting pre-approved really doesn't take that much time, energy, or effort, and it doesn't cost any money. A competent lender can pre-approve you sometimes in as little as the same day. Of course, a lot of it goes into your financial background and your makeup. If you're a W-2 employee, you're easier to get pre-approved because your paperwork's more straightforward. If you are a 1099, self-employed, independent contractor, it's a little bit more difficult. But it's a really good idea to get pre-approved because at least then you have the option. And maybe let's say that you find a new house, you've got, you sell a house, it sells for $500K, you own it free and clear, there's no loan. Now you have $500,000. And the next home you're going to buy maybe is $500,000. Well, maybe you say, you know what? I want to put $350,000 down, and then I want to take $150,000 and I want to invest it. Or I want to take $150K and open a business, or take $150K and renovate the house, or do whatever you want with it. Then that way, at least you already have a pre-approval so that you have the flexibility to utilize that loan. And even with high interest rates, that mortgage is going to be so small that your payment's going to be really, really manageable. So yes, I would say, to sum this up, it is still a really good idea to get pre-approved because it just gives you flexibility. It just gives you another option. And then you can choose. Do you want to get a loan? Do you want to pay cash? What makes more sense for you in that situation? Yes. So our current residence is paid off free and clear. So yes, exactly. So in this situation, I would still get a pre-approval and see what a lender has to say about what they can do for you. And then, like I said, you just, you have more options available. So thanks for tuning in, John. Okay, so let's continue. So despite the appeal, the program still enforces standard lending criteria. Potential homebuyers must meet other underwriting requirements, including appropriate debt-to-income ratios and the legal requirement for lenders to ensure the consumer's ability to repay the loan. So this is important. This is basically one of the ways that they're trying to mitigate against another 2008. They're basically saying that, hey, we're not just going to give people a bunch of money to go buy a home. That's what we did in 2008. In 2008, we had ninja loans, no income, no job, no assets, which means that you didn't need any of those things in order to go get a loan. That is just so extremely risky. And that's why we found ourselves in a huge financial meltdown back in 2007, 8, and 9 was for that reason. So while those were sometimes 0% down loans, they were not monitoring any of the criteria of that lender, verifying income, verifying credit scores, verifying employment, none of that. And in this situation, that absolutely still is the case. So a little bit of a safeguard. Current market conditions, high mortgage rates, home prices, and interest rates have slowed down sales, This is just kind of some recap. If you guys follow me, you guys know about some of this stuff. You guys are smart, but we'll just recap it really quick. Rates peaked at just over 8% in October of last year, fell to the 6% range earlier this year, and rose again in May 2024. Right now, rates are between like 7 and 7.25. I'm not a lender. I'm not quoting you a rate. You need to speak with a lender if you are interested in getting a price quote for a rate or a loan. I'm just giving you some basic knowledge and information. The 0% down payment program, here we go. The 0% down payment program aims to help potential buyers overlook the high rates by removing the hurdle of the down payment. For instance, on a 30-year fixed rate mortgage at 6.75%, a $350,000 loan would result in a monthly fee of $2,270 for principal, interest, and mortgage insurance, excluding property taxes and homeowners insurance. So, not bad, $350,000 with a rate that's a little bit lower than what we're seeing, but still in the realm. $2,200, not insane, especially considering that renting that home is probably not going to be much more affordable than that. That's a whole other topic that I'm not going to get into today, the rent versus buy thing. We might cover that in another stream later on. But to build equity, to own your own home, to have, to be the master and commander of, of your domain, if you will, $2,300 a month isn't insane. Many consumers might find the monthly mortgage payment comparable to their current rent, but the challenge lies in saving for even a minimal down payment. So it goes back to what I was saying. They might think, hey, my rent is $2,300 a month or $2,200 a month, but the mortgage is $2,200 or $2,300 a month. So that's very doable. However, the caveat is I got to come up with $8,000 or $10,000 or $12,000 in order to get in the door. And this, obviously, they're hoping that this type of program will get rid of that hurdle. With inflation and high prices consuming more of their paychecks, saving thousands of dollars up front can be more difficult. UWM's new program offers a solution by providing down payment assistance, easing the transition from renting to home ownership. However, experts suggested to CNN that there are risks involved. And we're going to take a look at that CNN article in just a moment. The main risk is that homeowners will start with no equity since they're not putting down any initial payment, which could quickly become problematic if the housing market cools down and home values decrease. Another issue comes if homeowners need to sell quickly due to unforeseen circumstances. In that case, CNN noted that they would still need to repay the second mortgage. If the home sales price does not cover the mortgage debt, the homeowner might not have enough funds to settle the remaining amount. Patricia McCoy, a Boston College law school professor, said that UWM's offering mirrors the subprime mortgage crisis when many homeowners found themselves underwater and defaulted on their loans. So again, this college law school professor, which is interesting, nothing against Ms. McCoy. Obviously, she teaches at a prestigious college, Boston College, law school professor. I'm sure she's very smart. I'm sure she's very competent and aware of things. I don't know why we're asking a law professor what what their opinions are on a mortgage program. Maybe a finance or real estate professor, but I digress. They make a good point. They're talking about how, hey, this person's basically saying, I'm afraid that this is going to be a lot like the subprime crisis of 2008. Well, as we know, even though this is a more risky loan option, and even though this is a 100% finance option, the lending standards and criteria are still much more strict than anything we saw back in 2008. So it does expose these homeowners to a little bit more risk, but it's not like it's just going to be the Wild West. And it's not like going to be a free-for-all like it was in 2008 that led us down this spiral that was the great financial crisis. McCoy, who previously served as a mortgage regulator. Okay, so I take back my previous statement. McCoy does have some mortgage experience as a regulator. So McCoy, who previously served as a mortgage regulator at the Consumer Financial Protection Bureau, warned that history could repeat itself if risks aren't properly managed. And that's a key word, if risks aren't properly managed. So that's kind of the end of this article. And that is something I want to kind of go back up here and talk about, where they're talking about how if the market turns, it can be problematic. So the reason it can be problematic, and this is kind of where we're going to start getting into the pros and cons. And again, if you guys at any time have any questions about this, or want to share your point of view or opinion, let me know. Type into the comments. I would love to know what your thoughts are and what your kind of idea or what your take on this situation is. Do you think that 0% down loans are going to be positive, negative? Do you think it's going to be another 2008? Let me know. So the main risk is that homeowners will start with no equity since they're not putting down any initial payment, which could quickly become problematic if the housing market cools down and home values decrease. Now, remember, again, we talked about equity. It's the difference between what your home is worth versus what it owes, what you owe on it. So in this situation, let's say a home is $300,000. Let's say that you do a 10% down payment. And so that would be $30,000. It's $300,000 home, 10% down payment, $30,000. The outstanding loan balance is now $270,000. So if the home, the prices of homes were to go down, if the market were to soften a little bit, and let's say your $300,000 home goes down $20,000 in value in 3 months, which is very unlikely, and that's a very large amount to go down in a very short amount of time. But for example's sake, let's go with it. $300,000 house, you owe $270,000. It goes down $20K. It is now worth $280,000. So you started up here. You owe this much, so you have this much equity. But all of a sudden, now your home is only worth this much. Well, you still have this much equity. You still have this much positive. So if you did have to sell your home because you lost your job, got relocated for your job, there was a divorce, a death, a marriage, you had kids and you need a bigger home, well, you could still sell your home and make a little bit of a profit. So you're covered there. However, if you buy a $300,000 home, you put no money down and you finance all $300,000, you now have no equity, of no barrier. If the value of that property comes down to $270,000, you are now underwater by $30,000, or even it goes to $280,000. You're now underwater by $20,000. Now, if you have to sell that home because something happens, you think, oh, well, I'm going to sell my home. I'm going to get $280,000. Man, I'm down $20,000. Well, that's not a good thing. That is the definition of being underwater. You could be at risk for a short sale, or if you, it wouldn't be a foreclosure, because for a foreclosure, that means you have to be delinquent on your payments. So that wouldn't apply, but it could be a short sale, which means you're selling a home for less than what you owe on it. And that's a problem. Now, with this program, the reason this program could be a problem, the 0% down program, is now imagine, so you're at 300, you have zero equity, it goes down to 280. And oh, by the way, because you didn't put a down payment and you utilized this down payment program where you put, you basically took out a second loan for, let's say, a $10,000 down payment. Now, instead of just being in the whole 20 grand, you're in the whole another 10 grand, 30. And remember that amount, that $10,000 that you financed for the down payment, has to be paid off before the house can actually transfer. So you can't get out of it. You might be able to bargain with a bank and say, hey, I know I owe you 30. I'm going to sell the house right now. I can pay you 22. And the bank might say, hey, if it means that we don't have to go into a foreclosure and we don't have to do this whole long process, great, fine. We'll just settle up and you'll get a ding on your credit and it is what it is. Well, that won't happen. You're going to have to pay all that back. And that's why this program is a little bit risky. So I want to move on to another article real quick. Let me pull it up. This one just has it in a little bit more detail. This is actually the original article from CNN. I'm going to, again, make this one a little bit larger for us so we can see stuff. There we go. So wild stuff. While, yeah, it could be a benefit to some, there are some risks involved. And if we are not careful with these loans, we could see, 2008. I'm not super concerned for that. And I'll tell you why in a moment. All right. So this is from CNN Business. And a lot of this will be kind of like repeat, but I'll skim through it except for the parts where there's some different material and different information. Many Americans would love to buy a home. Yeah, we do know that. but they don't have tens of thousands of dollars to cover a down payment. The massive roadblock is being removed by a new 0% down mortgage program launched 2 weeks ago by one of the nation's largest mortgage lenders. However, the new program offered by United Wholesale Mortgage, UWM, is making some experts nervous about how these loans could backfire on homeowners, especially if home prices stop going to the moon, which we briefly covered. And for some, it's bringing back bad memories of the subprime mortgage meltdown that fueled the 2008 financial crisis. UWM, led by Matt Ashiba, the billionaire owner of the Phoenix Suns NBA team, said home buyers who qualify won't need to put down an upfront down payment. There he is sitting courtside at an NBA game for the team that he owns. Wouldn't that be nice? This guy certainly isn't going to take advantage of 0% down payment because this guy's a billionaire. Instead, the program will allow buyers to pay 97% of the home's value with a first mortgage and then provide the remaining 3% up to $15K in the form of a second. The second mortgage won't accrue interest, but will need to be paid back in full as a balloon payment when the home is sold, the mortgage is paid off, or the owner refinances. So this guy just again talks about how the demand has been huge for this. Talk about another wholesaler is going to be able to do this. So the mortgage brokers are able to have this new tool that will help people get off the sidelines. But yet some worry that this kind of mortgage could cause problems for homeowners down the line. The central risk is that because they put down no down payment up front, homeowners will be starting with no equity, which again, we talked about. That means they'd find themselves instantly underwater, which means owing more than the home is worth if the red hot housing market suddenly cools and home values go down. It could happen again. That could be a problem if the homeowner needs to sell quickly. Perhaps they lose their job, face financial distress, or need to relocate, like we kind of talked about. Suddenly, they'd be on the hook to pay back that second mortgage. And because they're underwater, the home won't generate enough cash to retire that debt, which is the scenario we just ran over. If the homeowner lacks the cash to make up the difference, then he or she will be in default on the second mortgage and at risk of foreclosure and damaged credit. And again, they're quoting this Ms. McCoy from Boston College Law. And she's talking about how this is exactly what happened in the subprime crisis. I mean, yes, it is exactly what happened, but in a different way. It's like saying, I eat eggs, but I don't eat scrambled eggs, but I eat deviled eggs. You're like, well, you still eat eggs. Well, yeah, same thing. But it's two completely different ways, two different things. I understand what she's saying, and especially knowing now that Ms. McCoy has a history in consumer protection. Get this ad out of here. Even though that she's, we know that she's got a background in consumer protection, she's going to be a little bit more cautious, which, hey, I don't blame her. I think it's a good thing. I think we definitely need to be cautious when we're lending people hundreds of thousands of dollars. The housing bubble that popped around 2006 was fueled in part by an explosion of lending to subprime borrowers. In the years leading up to the bubble, lenders came up with new products like adjustable rate mortgages, no down payment loans that ended up blowing up when home prices eventually collapsed. Now, this is something completely different. This is not an adjustable rate. In fact, adjustable rate mortgages are almost non-existent. Almost everyone, a vast majority, over 90% of homeowners have a fixed rate mortgage. So that right there kind of negates some of that. Locked into high rates. To be sure, right now the housing market is on fire. Home prices are at record highs and demand is so strong that some homes are selling above asking price after all cash bidding wars, of course. Still, another potential issue is that homeowners could find themselves locked into high interest mortgage rates if the Federal Reserve starts cutting interest rates. That's because in order to refinance at a lower rate, the homeowner would need to fully pay off that second mortgage, and they may not have enough cash to do that. Another thing to consider is that if they do refinance, let's say they're at a 7% rate, they utilize this program, they're at a 7% rate, and mortgage rates go down, and they go down to 6.5%. They'd probably want to refinance. 0.5% makes a pretty big difference in a 30-year fixed mortgage. Well, now, not only are they going to have to pay costs due to their refinance, because there are costs associated with refinancing, but they're going to have to pay that second loan. Now, if that's $8,000, $10,000, $12,000, or the max up to $15,000, they got to come up with that money. There's no two ways about it in order to get that refinance. And that could exclude them from taking advantage of the lower interest rate. There are other options for zero down payment mortgages. For instance, Bank of America launched a zero down payment mortgage program in 2022 for first-time homebuyers in certain Black and Hispanic neighborhoods. It's a very, very, very targeted program. And that program is so targeted that even if everybody took advantage that was able to, and then everybody defaulted, it wouldn't make a big difference. So Bank of America was just trying to offer a program, but limit some of their exposure, which makes sense. As Bankrate notes, there are also zero down home loans backed by the U.S. Department of Agriculture in rural areas, as well as loans for veterans and surviving spouses guaranteed by the U.S. Department of Veterans Affairs. So 0% down mortgages are nothing new. You can get them with a USDA loan, which is reserved for agricultural properties. So think farms and ranches, but also VA. That's one of the big benefits to utilizing a VA benefit is the option to go 0% down. And those loans are backed by the federal government. So they're not seen as nearly as risky. On top of that, it's shown that service members and veterans typically take homeownership very, very seriously. After all, they sacrificed a lot of their time and energy, and they went and served our country. And so a lot of the times they have a very vested interest in home ownership. On top of that, veterans typically have pretty good employment opportunities once they are out of the service. So their income typically is a little bit more stable. Now, of course, there's always exceptions to everything, but VA loans are looked at as being very solid, very secure, very safe, even though they are 0% down. Now, with VA loans, same thing. Anytime you put 0% down, your monthly payment is going to be higher. But if that gets you in the door to home ownership and you can start building equity, then it could be worth it for you. Read the fine print. You should always read the fine print. Annalise Lederer, Senior Policy Counsel at the Center of Responsible Lending, said it's crucial for homeowners considering the UWM loan program to be educated about terms and conditions. Using fun lines like no down payment sounds exciting and great, but you need to read the fine print, Lederer said. This could be a fantastic product to allow people who can afford mortgage payment but don't have the down payment to access homeownership. But the question is, how do you pay off that second mortgage? What is the plan? Right now, there is no plan. Dennis Kelleher, CEO of Better Markets, a nonprofit that advocates for tougher financial regulation, told CNN he worries what a mortgage product like this will hurt some borrowers if the housing market stumbles, which is a definite possibility. These mortgages are going to be a ticking time bomb, just like subprime mortgages. I disagree a little bit, unless home prices continue to increase very substantially, Kelleher said. This has the potential to turn the American dream of home ownership almost immediately into a nightmare. Now, I think he's perhaps being a little overdramatic here. By all intents and purposes, it very much does seem like we are going to see continuation of home appreciation. Homes are slated to appreciate in pricing anywhere from about 4 to 5% over the next 3 years per year. So I don't see that happening. However, I also I wouldn't liken these to subprime mortgages. Again, subprime means a loan was made to somebody that should have never have gotten that loan. They don't have the ability to pay it back, but they were given that loan anyway. With these new strict lending criteria post 2008, I don't necessarily know if I would consider these subprime, but we'll just have to wait and see. I do understand the concern, though. It does make a lot of sense. Existing home prices jumped by another 6% last month, year over year, to $407,600, the highest median price in April on record. So that just goes to show you that they are increasing. We don't know if we are in a bubble that is going to burst or if the trend lines are going to increase, but pushing 100% mortgage products on low-income people when housing prices are at historic highs should cause everybody to be very concerned. That I do agree with, because the demographic they are targeting is a demographic that can't come up with a down payment, has to make 80% or less of the median income for that given area that they're trying to purchase a home in, or is a first-time home buyer. Quite honestly, if you fall into that group and you make 80% or less of the median income, you can't come up with at least 15 grand for a down payment, maybe it's not the right time for you to buy a house. And this kind of goes back to what I opened the stream with, I'm not one of these agents that just says it's always a great time for everyone to go out and buy a house. Now, is real estate a great investment? Absolutely. Is it typically better to go out and start earning equity as opposed to rent? Yeah, most likely. And of course, most people want to be able to have control of their destiny. They don't want to worry about getting a 30-day notice to move out or rent going up. So buying a home is great for all of those reasons. However, it's not perfect. It's not the answer for everyone. And I feel like the borrowers and the consumers that these products are specifically targeting, maybe they're not in the position to be considering buying a home right now. Maybe they need to save up a little longer, maybe get their income up, maybe find a partner that they can co-purchase a home with. Doesn't necessarily need to be a girlfriend, boyfriend, husband, wife. It could be a family member, could be a friend that you trust. But that line still rings true. But pushing 100% mortgage products on low-income people when housing prices are at historic highs should cause everybody to be concerned. I don't necessarily disagree with that. Lessons of the subprime crisis. Jonathan Adams, an assistant professor at St. Joseph's University teaching real estate finance, said the UWM loan program has all the features that made subprime bad. People who UWM pushed back on these concerns. Of course they did. They're looking to make money from this. UWM pushed back on these concerns, noting that borrowers must still go through strict underwriting guidelines, which I get. I understand that does make sense. And this is why one of the reasons I don't think you can equate these loans to subprime loans of 2007. People who make these claims are uneducated about the current state of the industry. Boom, bang, bang, shots fired. Like this guy just came out, this UWM executive just came out and was like, these people are uneducated, which interestingly enough, in today's environment, UWM is responsible for underwriting the loan, which gives us confidence that these are high quality loans. So when they say we're responsible for underwriting the loan, that's basically them saying, not only are we the ones selling the loan product to these people, but we're underwriting it, which means we have the duty to verify that these people are qualified for this loan. And then we're going to be the ones that actually lend them the money. So they've got some skin in the game on it. This is a huge positive. It's helping consumers and is a great win across the board. Well, of course, one of the executives of the company is going to say that. Think about all the people who are renting and would love to buy a house, but they face this roadblock of coming up with $10,000 or $15,000 for a down payment. This eliminates that. Well, it doesn't eliminate. I mean, it eliminates the roadblock, but you're still paying for the money. It's not like it's just getting rid of the need for a down payment. Also, it's also worth noting that some experts say lending standards have been improved significantly since the 2008 financial crisis. This is what I was talking about earlier. Talking about ninja loans, no income, no job, no assets, and adjustable rate mortgages are largely gone. We're not going back to 2006 here, said Greg McBride, chief financial analyst at Bankrate. Lending standards are light years removed from pre-crises when there oftentimes weren't any standards at all, which is absolutely true. There's stories of people using false information from people who were deceased to go get a loan for a $400,000 or $500,000 home. This is back in 2006, 7, and 8. People walking in to a mortgage banker and saying, "Hey, here's my name. I make $100,000 a year. I want to buy a house that costs this much. What kind of loan can you give me, and how quickly can you approve me?" And the mortgage lender just goes, "Boom, here you go. Here's money." Horrible, horrible way to do business. And of course, it led to a huge collapse. Yet Adams, a former Wall Street analyst, cautioned that someone who can't make a down payment and makes less than 80% of the median income, which are the people that qualify for this program, is likely to suffer more in an economy when home prices are falling. One of the lessons of the subprime crisis, Adams said, was that you're not doing any favors to borrowers by making it too easy to borrow, which is true. And this portion right here is like, that's what I was saying earlier about what I would be afraid of. Think of it like this. Think of if you had 3 people running on a treadmill, and think of that if all 3 treadmills were going at the same speed, let's say 10 miles an hour, but the first person is a marathon runner The second person is an athletic person. They, go to the gym a couple times a week. They're in shape, but, nothing fancy. And the third person is really out of shape. They haven't been on a treadmill or ran in 10 years, and they're getting on running this thing. Okay. Well, as you can imagine, as the speed of that treadmill starts to increase, the person that is way out of shape, that hasn't gone to the gym in a really long time, they're going to be most likely to fall off that treadmill the first because they're barely hanging on to begin with. That would be equivalent to people that are in this kind of financial bracket utilizing this product. They're already pretty strapped. And if anything goes wrong, it could be the straw that breaks the camel's back. Whereas people that, have 20% down on a home that they bought 2 years ago, and if prices do go down, so prices went down 5%, which would be a lot, but I still have at least 15% equity in the house. If I need to sell it, I can pay the bank off, I can pay any fees, and I might even pocket a little bit of cash. So that's why they're talking about this being a real big problem for people that are in this price point, because they're already sort of like, right on that cusp of something going wrong and them not being able to make it. So again, this is the original article from CNN. I've got one more article to show you. This talks about pros and cons of the 0%. I hope this article works. It was giving me some troubles. Oh, look, great. Looks like it's going to work. So this talks about 0% down mortgages might help more first-time home buyers break into the housing market, but there are caveats. And before we get into this article, again, just a quick reminder, if you like this content, if you like the information, if you're digging the stream, please hit the like button down below, subscribe to this channel. It really does help me out. It doesn't cost you anything. It's free. It's easy to do. Please go ahead and do it. So this one comes from fortune.com, and look at this couple. Like, you can tell, like, this couple, they're worried. Like, look at the expression on their faces. She's like, I don't know if we can do this. And he's like, you're right. I don't know if we can do this either. And, they're going over the spreadsheets, they're dialing in the numbers. And that's what most people feel like right now, trying to navigate the home market. It's not surprising, zero down mortgages are making a comeback, as CNN recently declared. That's the article we just read. After all, home prices skyrocketed during the pandemic-fueled housing boom and have continued to do so since, recently hitting their 9th all-time high within the past year. That's crazy. Only making down payments more costly and somewhat unrealistic for a lot of people to do. So I'm not going to get into a lot of this stuff. It talks about, in March 2020, average home price in California is $572. Now it is $786, which is a lot. So back in 2020, just 4 years ago, average down payment would have been $114,000. Now you would need $157,000. That's a crazy amount of money. Last month, UWM announced this new program, kind of talks about, what, again, recaps the program. This is kind of an interesting portion here. It would buy a typical home. So the sale price can't exceed $500,000. So you can't buy a typical home in California, although you would in other markets, including Texas. I know also in like Louisiana and some other states. I think Vermont or Connecticut was another state where the median was below the $500,000 price point. So it does work in some areas. It won't work in your major areas like your Seattles, your LAs, your San Franciscos, your San Diegos, your parts of Florida. Parts of Florida it will work. Your New Yorks, things like that. Just be aware of that. So the pros of a 0% down payment. In some cases, would-be buyers have financial means necessary to keep up with monthly mortgage payments, which are substantially higher the less you put down, but coughing up tens of thousands of dollars for closing can be a stretch. So if you can sustain the monthly payment and have some sort of reserve, then it solves a bigger homeownership problem. In other words, 0% down payment programs might allow people who wouldn't traditionally be able to purchase a home break into what feels like a broken housing market. Still, they'll need enough money each month to pay for their principal, mortgage, interest, taxes, and insurance, and that pesky HOA if it applies to that property. Homeownership is important for the wealth accumulation, Mansfield said, and it has been for decades. As we all know, generational wealth typically starts with real estate and homeownership. I've said this stat before, but if you own real estate, you are typically 40 times more wealthy than someone who does not own real estate. Keep in mind that I'm not talking about renters versus owners. I'm talking about owners versus non-owners. You can still rent a property, but you can still own real estate. Home ownership is important for wealth. It's important for neighborhood stability. It's important for making sure kids stay in the same school system while they're growing up. Plus, these programs can help with diversity and equity for home ownership rates, she adds. And the cons, there are longer term ramifications to understand. Namely that the homeowner wouldn't have any equity in their home from the start. We've kind of talked about this. The risk of that position is that the value of the home goes down. The concern is that you will get trapped in the home, Mansfield said, or when you sell or try to refinance, you're going to, as a seller, have to bring a bunch of money to the table, which is typically not what you want to be doing when you go to sell a home. The goal of selling your home is that you make a bunch of money and you can take that money and put it back into another piece of real estate and it will grow and so on and so forth. Even if a homeowner doesn't have to sell and home values were to fall, they could owe more than what the home is worth. But UWM argues its program won't fuel another subprime mortgage crisis. They just don't know what they're talking about. Again, this guy, Alex, is just firing it off at people. They just don't know what they're talking about. Referring to those suggesting the program could result in another result in another subprime mortgage crisis, or simply comparing the two. They're just uneducated when it comes to the reality of what we're dealing with today. Great legislation, great compliance around loans, and ultimately UWM is making that decision on the loan of whether we're actually going to do it or not, and we're going to do it in a safe and sound way. Again, a little bit slanted. This is coming directly from an executive at the company, but he's not completely wrong. And home prices might not fall anytime soon, which would kind of negate that argument of the subprime thing coming back, let alone fall as much as they did during the great financial crisis. I do agree with that. I see no signs of homes declining in value, and certainly declining in a value that is as aggressive or as severe as we saw in the 2008 recession. We're constantly reminded that this housing cycle is unlike any other. While mortgage rates have soared and sales volume declined, home prices didn't follow their typical pattern of plummeting. They rose. Part of that has to do with the 30-year mortgages, and another has to do with the fact that we're missing millions of homes, which that's the big one. If you've watched any of my streams before, you know how hard I've hit that. This is an inventory problem. We don't have enough homes. We've got a lot of people. And that's the biggest issue that we're facing right now. So before we go on to the next thing, I'm going to queue up this video really quick. And again, if you guys have any questions in the comments, please let me know what those questions are. I'm always happy to answer them and address them. I'm queuing up this video right now. It's got this pesky commercial that I'm going to forward us through. And here we are. Put this tab up. Bingo. We're going to make this full screen. Y'all should have audio as well. So this comes from Good Morning America, and this is really recent. And this is talking about the 0% down payment program. Here we go.
To look at the return of zero down mortgages, appealing to first-time home buyers who may be struggling with that initial hefty down payment, especially in the face of higher interest rates. But financial experts warn you need to be aware of the risks. ABC's Alexis Christophorus is here with more on that. Alexis, good morning.
Good morning to you. Zero interest down payment loans may bring back bad memories of the subprime mortgage crisis that sparked the Great Recession of 2008. But this time, lenders say it's different with stricter.
Now, it's a little bit scary because like anytime something bad happens, and there's like a cycle of things, and I'm not just talking about real estate or housing, like whatever it is, right? Like you always hear someone say, no, but this time it's different. Like, no, I understand last time it sucked or had a problem. No, but this time it's different. So I can completely understand why people have fears of this program and why it does, kind of make people have this knee-jerk reaction, this twitching, oh God, the shuddering back to 2008. But I get it, and hence the stream title. Are we going back to 2008? I don't think so, but this program, this 0% down program, kind of makes it feel that way. Let's continue.
Underwriting guidelines meant to protect the banks and consumers.
This morning, a new option for prospective home buyers struggling to find the money for a down payment. The lender United Wholesale Mortgage letting qualified buyers purchase a home without putting any money down. And with rising home prices and mortgage rates now back above 7%, it's grabbing lots of attention.
They are back above 7%, but like I said, they're like this much above 7%. So like, it's not like, oh my gosh. And they've been around this price point for a better part of a year now or so.
Since launching the 0% down purchase plan 2 weeks ago, the lenders received over 2,000 loan applications.
The biggest obstacle to home ownership is the down payment, and this down payment is just.
So this is the guy. This is Alex Elzaj. This is the guy that was just like firing off shots like, oh, this is not going to be subprime. We're making sure that everyone's qualified. This is the guy that just said people were uneducated by comparing this to subprime loans. I kind of commend the guy for just like saying what he wants, but yikes, that's quite the claim to make.
Since program solves that for most consumers across America.
To be eligible, you must not have owned a home for at least 3 years, meet certain income and credit score requirements, and use a mortgage broker.
So those, let me just go back so those stay on the screen for a second. So these are some of it. They're not breaking down that you meet income and credit score requirements. So we kind of talked about that. We covered that in the articles that we talked about. Haven't owned a home for 3 years. So you don't have to be a first-time home buyer, but you have to be, a sort of newer, more recent home buyer. And you have to use a mortgage broker. Not a huge deal. I've got my thoughts on mortgage brokers. Sometimes they're great. Sometimes they're horrible. It really depends on the mortgage broker that you're working with. Like anything, whenever you're working with a professional, whether it's a mortgage broker, a real estate agent, a doctor, a mechanic, a lawyer, anyone really, a contractor, you just want to do your research, do your due diligence, try to get a referral from someone. If you are out there and you're interested in this loan program, feel free to shoot me a DM. I can get you some information from a good lender that can, provide you more information. Or if you just have questions about different types of loans or how to get pre-approved or the home buying process, shoot me a DM, call me or text me. I'm always happy to help.
Use a mortgage broker. Qualified borrowers can receive $15,000 or up to 3% of the purchase price of a home, whichever is less. But experts say it's important to remember it's not a gift, but a second loan in addition to your mortgage.
That is very, very, very important to understand and realize. It is not a gift. It is money that you'll have to pay back. Now, the cool part is it's zero interest, which actually is really, really nice, but you got to pay it back. It's not a grant. It's not a credit. It's not a tax write-off. You got to pay it back. It's a loan.
It's not a freebie, in other words. You have to pay this money back.
If you refinance, sell the house, or pay off the mortgage, you must pay back the down payment loan in full.
This 0% down payment promotion could be golden handcuffs in a way if it either prevents you from refinancing or makes it more difficult and expensive to refinance.
We talked about that a little bit. So the golden handcuffs, we've heard that. So that right now, golden handcuffs is typically a term linked to people that have low interest mortgage rates. So the people that have 2.75, 3, 3.25, 3.15, stuff like that. I'm sure there's people here in the chat that refinanced during COVID and they got a killer rate. I know I did the same thing. Of course, I have since sold that house and bought another house. So I don't have that. I have a good rate because I bought my next house before rates really shot up, but they did increase. But I'm sure there's people here in the chat that are sitting on 2.5% or something. And good for you if you are. But that's that term where the golden handcuffs come in, where it's like, I've got something, it's so good, I don't want to give it up. It's almost too good to be true. So because it's too good to be true or almost too good to be true, I'm locked in. I can't do anything. I can't give it up. I can't afford to give it up. And that's the similar situation here. And my fear is that especially when it comes to refinancing, most likely people that utilize this loan program and most people that buy homes don't sell their home within 1 to 3 years or even 1 to 5 years. Most people are in their homes for 7 to 10 years, which is typically the minimum that you need to be in order to make any money off of that purchase. But if someone wants to refinance the home in 2 or 3 years after they purchase it because rates go down 0.5 or 0.75%, which is a lot, they may not be able to do it because they're going to have to pay $10,000 or $8,000 or up to $15,000 because you cannot refinance until that until that second mortgage for the down payment has been paid off. So definitely that is something that could certainly kind of golden handcuff people in, which is not a good position to be in.
That was not a deal breaker for Olivia Reindl.
I think I've spent most of my young adult life saving up for a house.
She recently closed on her first home after securing a $10,000 zero interest down payment loan.
I could look at more higher end homes that I may not have been able to afford with the 3% down. And also it allows me to kind of put that money back into the home.
So that's a little bit concerning because this young lady, first off, I'm glad that she was able to become a homeowner. That's a phenomenal step for her. I wish they would have said what market she was in, because she used the 10,000. So she didn't even use the max. She used 10,000, which means that she probably bought a home around 420,000, somewhere in there. But she said that I was able to look at higher end homes. And that's a little bit concerning because can she actually afford it? And obviously she's happy with her decision. She's getting into homeownership. Hopefully the market will do great and it will go up and her equity will increase. But that's a little bit of a red flag for me, just knowing like, hey, you give people an inch and they're going to take a mile. And that's what happened in 2006, 2007, 2008. Banks said, okay, we'll give you a little bit of leeway. We don't need this document. We don't need that document. We'll just approve you for the loan. And then all of a sudden people are like, oh, well, if you'll approve me for that much, can you approve me for another one and another one, or a more expensive loan or a bigger loan amount, whatever the case may be. So that's a little bit frightening to hear.
Now, down payment assistance programs aren't new. Ask your bank and check with your state and local governments to see if they offer low or no interest loans or even grants to help with those down payments and closing costs, because we know that is one of the most challenging things when it comes to home.
And that's a really, really important note. Before you just go to sort of like, I don't want to call the 0% down loan program that UWA is offering, I don't want to like say that's like the easy button or like a shortcut, because it's not. But like before you look at something like that, you should absolutely talk to a local lender or a local mortgage broker and say, hey, is anything available? I'm a first-time buyer, or am I eligible for any type of products? I'm a teacher, I'm a first responder, I'm a doctor, something, sometimes there's different loan products out there specifically for certain, job types, statuses, things like that. That can offer some type of assistance in down payment, whether it's a grant or a credit or something like that. Always look at those first. Try those first, because chances are those are going to be a little bit more straightforward, a little bit less risky than just, getting some quote unquote free money, which always comes with strings attached.
Homeownership.
Absolutely. And we were just saying during the piece that it sounds too good to be true, but it does help some people. So.
Yes, eyes wide open. You got to go in eyes wide open.
Absolutely. All right, Alexis, thank you so much.
Yeah, so that's, the whole thing is really, really interesting. I don't know if, 0% is the correct way to go or the correct thing to do. It's an option, and that's good for people. I'm glad that they at least have it, but I don't know if it's the best thing to do. And only time will tell, if we're going to have an issue with this. So again, it's just one of these things where we don't know what the outcome is going to be. Hopefully the people that do utilize this program, hopefully the people that do decide to, go with this type of program, hopefully the market continues to go up. Hopefully they don't have any issues with equity. Hopefully they don't need to refinance right away or sell because of job loss or hardship. And hopefully it all works out. Again, guys, as the stream concludes, thank you everyone for being here. I appreciate everybody watching. If you're watching on the replay, thanks for taking a look at the stream. Don't forget to like and subscribe. Please like the video and the stream by hitting the like button. It does me a little bit of a benefit, helps out the channel. If you guys ever have any questions about real estate, whether it's local to Los Angeles, Southern California, or someplace across the nation, don't be afraid to ever drop a comment on my videos. You can always send me a DM, or you can reach out to me by email. In my description, on my channel, I have my bio, and there's a link to contact me through that. Always no obligation and no cost. If you're looking for a real estate agent, I'm happy to work with you or connect you with a real estate agent in the area that you're looking to purchase, if that's not Southern California. So I hope everyone enjoyed the stream. I hope you're all having a beautiful week. I hope you have a great rest of your week ahead. And I'll see you next Wednesday for another stream. See you, everyone. Bye.